Just a quick note before we begin. This explainer from Block-Spawn's funds is for educational and informational purposes only and should not be considered financial or investment advice.
All right, today we are diving into a really crucial piece of the crypto puzzle, stablecoins. We're going to break down how these things were basically engineered from the ground up to solve crypto's biggest headache, that wild, unpredictable price volatility, by creating what you can think of as a foundational layer of stability.
So, to really get why stablecoins are such a big deal, you first have to understand the core problem they were built to fix. Since day one, assets like Bitcoin and Ethereum have been famous, or maybe infamous, for their extreme price swings.
Now, this isn't just an issue for day traders trying to make a quick buck. This kind of volatility creates a massive barrier. It stops cryptocurrencies from doing the one thing money is supposed to do, be a reliable part of our financial lives. I mean, think about it, right? If your savings could plunge 20% overnight, it's not a great store of value. If the price of a gallon of milk is changing by the second, it's basically useless as a unit of account. And if you're trying to buy something and the value of your money changes before the payment even goes through, well, it's just not going to work. For any real financial system to take hold, its core assets just can't be that chaotic.
So this led to the big question for all the early builders and developers in the space. How in the world do you build a reliable, stable financial system on top of a foundation that's constantly shaking? The search for an answer to that question led to one of crypto's most vital innovations.
And the answer they came up with was frankly brilliant. Instead of just hoping the volatility would magically disappear, they decided to engineer stability directly into the system. They set out to build a brand new type of token, one designed specifically to hold its value and act as an anchor in the storm.
And that, in a nutshell, is a stablecoin. It's a crypto token, usually running on a blockchain like Ethereum, that's programmed to keep its value locked to something stable in the outside world. Most of the time, that's the US dollar. What you end up with is essentially a digital dollar, one that lives and breathes entirely on the blockchain.
Okay, so how do you actually build one of these things to hold its value? Well, there are basically three main ways to engineer this price peg, as it's called. And as you can see here, each one involves a really different set of trade-offs when it comes to things like trust, risk, and decentralization. Let's walk through them.
First up, you've got the most straightforward approach, fiat-backed stablecoins. Think of coins like USDC or Tether. For every single token out there, the company that issues it holds $1 worth of real-world assets, like actual cash or U.S. government bonds, in a bank. The trust here is simple. You trust the company to have the reserves and to give you your dollar back if you ask for it. The second model is a bit more crypto-native. It tries to create stability without touching the traditional banking system at all. With a coin like DAI, to create it, you have to lock up other crypto assets, like Ethereum, into a smart contract. But here's the key. You have to lock up more value than you get out. So you might lock up $150 worth of ETH just to mint $100 of DAI. That extra $50 is a safety cushion in case the price of ETH drops. And then we have the third model, which is by far the most ambitious and experimental. Algorithmic stablecoins have no collateral backing them at all, zero. Instead, they use complex code, smart contracts, that act like a tiny automated central bank. If the price goes over $1, the code automatically mints more coins to bring it down. If the price drops below $1, it buys up coins and burns them to push the price back up. It's all managed by code. So, okay, you've got these three different ways to build a stable token. But why does this matter? I mean, why is this so important? Because stablecoins quickly became the absolute, undisputed backbone of the entire ecosystem of decentralized finance, or DeFi. Seriously, inside DeFi, stablecoins are everything. They are the currency used for most trading, they're what you use as collateral to borrow, and they're what you lend out to earn a yield. When the market gets scary and volatile, they're the safe asset everyone runs to. They're the financial lifeblood that pumps through the veins of this entire digital economy. You can think of them as the universal translator, the common financial rail that allows all these different DeFi apps, lending platforms, exchanges, you name it, to talk to each other and work together. They provide that solid, dependable foundation you need to build something as ambitious as a global, 24/7 automated credit market. But, and this is a big but, the system isn't perfect. Some of these engineering models, especially those purely algorithmic ones, have proven to be dangerously, even catastrophically fragile when put under real-world stress.
In May 2022, the crypto world got a brutal lesson in just how fragile they can be. the algorithmic stablecoin called Terra USD, or UST, and its sister token Luna completely collapsed. In just a few days, over $40 billion, with a B, of value vanished into thin air.
What happened was a mechanism that traders now fearfully call a death spiral. It all started when UST, the stablecoin, lost its $1 peg, just by a little bit. But that was enough to spark panic. As people started selling, the algorithm kicked into overdrive, minting massive amounts of the Luna token to try and prop the price up. But that just flooded the market with Luna, crashing its price. And since Luna's value was the only thing back in people's confidence, the entire system just shattered. It was a feedback loop from hell, and both tokens went to zero.
As you can imagine, an explosion that big puts stablecoins directly under the regulatory microscope all over the world. This quote from the U.S. government really says it all. Regulators are now intensely worried about the risk of a run, just like a bank run, on stablecoins that don't have very clear, very high-quality reserves backing them up.
And all of this leads to the central tug-of-war that's shaping the future of stablecoins. Do we go with these centralized models? They're definitely more stable and easier for governments to regulate, but you have to trust a single company. Or do we push for the decentralized ideals of crypto? Total transparency, no single point of failure, even if it means dealing with more complexity and potentially more risk.
So let's bring it all home. The big insight here is that stablecoins aren't just tokens that are worth $1. You have to think of them as a fundamental piece of infrastructure. They are a stability layer, engineered from scratch to solve crypto's original sin of volatility. They are the innovation that makes a decentralized financial system even conceivable.
And that leaves us with a defining question as we move forward. As stablecoins become more and more important to the global economy, can we find a way to design them that gives us the best of both worlds? The freedom and openness of crypto, combined with the rock-solid stability that the traditional financial world absolutely demands. Answering that question is key to what comes next, and it perfectly sets the stage for our next topic, the incredible DeFi systems that are being built right on top of this stability layer.